Good afternoon, everybody. Welcome to the Strategy of the Week webinar. I'm Dan Hussey from Zaner Ag Hedge here. It is 2 p.m. on Thursday, November 11th. Want to start today. We'll begin with actually talking about the dollar index. I think some dollar strength here in the market is starting to we're starting to see it rearing its head and some trade wins against export markets. We're seeing that, I think, across many spectrums here. And that weighing against maybe some pricing that we would otherwise hope to see get be the wins that would be otherwise enticing China to come in and buy more grain at this time of year. Now, that doesn't mean to say that there might not be other avenues that business isn't getting done, and we'll take a look at some of those maybe in the meal here today as well. I think there might be opportunity in the meal that we see a really good trend starting to form there. But remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. But if you are interested in turning everything we talk about today into a trade, want to talk about how you can put it to action for you, I'm always here to discuss that. And you can always, of course, find my details in the comment section and in the information section of this video. And give me a call, 312-277-0110. Love to talk to you about opening up an account and getting active here with these ideas, if you're not already. So with that being said, the dollar index trading back above the 95 handle here and retracing into the 50% retracement of its decline from the 2020 sell-off that began after the pandemic set in. We saw a period of dollar strength that took us from dollar really multi-decade. I think it was almost a 20-year dollar high at that point for the dollar index that sold off from well above that 100 figure and brought us down to test all the way down just below the 90 figure and really was the high end of the range from our last recession back in 2008 through 2012. After that period, the dollar strengthened somewhat. We started a new range for the dollar between 100 and 90, and we've been trading in that range ever since. The 95 figure is right in the middle of that range, pretty easy number to remember. And now that we've bounced up off that 90 area, that proved itself as support here earlier this year and through all of 2021 so far. We were below, but it was we never really hung out down below that area. And we are looking at the the outright December contract here for the dollar index, not that continuous contract. At this point, we're deep enough into it that this would be the front month future. The 100, 255-day moving averages would be all the same. And this 18-day moving average being a key technical indicator, we remained above and held it as support on a test of 94 there. I thought we were turning and breaking below, but trendline support against the lows here, along with our moving averages, and really just continuation of a technical trend higher for the dollar continued. We see that following through, in the Treasury market right now. We're seeing a sell-off in the 10-year. Maybe the 10-year and Treasuries are starting to capitulate a low against the recent Fed news that we had, and we're starting to see that maybe the market start to demand the Fed start to act about some of the inflation pressures we're seeing. So a falling Treasury, is the equivalent of the Fed raising rates, if you will. And I think the Treasury market is starting to put that pressure on the Fed to take some action and do something because inflation is starting to rear its head. We saw CPI data come out well above, almost double what trade expectations were. And that was a bit of a shocker here that sent many other markets like gold and silver, where we see that inflation trade playing out, through the resistance into new monthly highs. But interestingly enough, we also saw the dollar rally. And the dollar rallying, the currency itself, I think, is in response to seeing the Treasury notes sell off or the real yields on the dollar rise. And a market that's forever chasing yield has found and chased some of that yield into the U.S. dollar currency. Now, again, the sell-off in the Treasury futures representing a pressure on the Fed to raise interest rates to curb some of the inflationary pressures. That's probably a good reason why wheat has started to rally like it has. A higher U.S. dollar, a higher U.S. dollar means that prices for wheat need to continue, to ration away from the global market. But it's actually interesting to see that we're seeing, wheat rally in the face of that. So that's why I think that there's the inflation trade. Sorry, got ahead of my thoughts there. But the wheat is a big proponent as to why I think this is an inflationary trade, and the rally in the dollar, while it's put some headwinds on exports, it's not the end all be all here for the market, and it shouldn't be a major reason why we'd be concerned going forward as to why exports won't happen. Because I think that will correct itself when we get some Fed action or something else occurs here. But rallying the dollar index, we'll see if it starts to put in a top here. I mentioned earlier the meal. I want to take a look at the meal here, December soy meal. I think this is where we're starting to begin a breakout here above this 100-day moving average, the 18-day moving average finding its way as support now. We've technically turned a corner here for the meal, and I do think we're heading back to a test of that 200-day moving average. We're above trendline resistance, we're above our moving averages. This market looks like a market that has started to reverse that downtrend, and meal rallying is a great supportive factor that could continue to keep the soybeans, keep some interest under the soybeans at this time. And hey, with corn and wheat as strong as they've been, it's remarkable soybeans haven't followed through enough. And I think the soy meal chart is going to be the big surpriser here. If we get that rally in the meal up to the 366 area, it's going to be hard to keep soybeans down, in my opinion, for another test of $13. But we'll see what happens. Of course, that's assuming corn and wheat remain as well bid as they are. Corn, 569 in the December contract here, with January wheat at 1221. That 1221 figure in the January wheat, divide that by the price, the current price of December corn here with 569. 1212 divided by 569. There we go. We've got a current corn to bean ratio of 2.13. So that means, right, every bushel of beans needs to be priced out 2.13 above the current bushels of corn at the or at the current. You need to be able to yield that in order to justify those acres as well. So that 2.13 corn to bean ratio right now, the pricing ratio, we were as high as 2.8 to 2.4 this year. This is as tight as it's been. 2.11 yesterday I saw as well. I think we're going to start to see a correction in this back towards 2.2, 2.3, 2.4. What does that mean? That either means corn needs to drop to come down to the price of, to move that ratio relative to the price of beans, or price of beans needs to start to rally here. If we've got mean rallying, we've got a corn to bean ratio that suggests beans might come back better bid here. It will be interesting to see if that really begins something higher. Well, the technicals here for the chart of soybeans, we've got trend lines against the highs, trying to break above that 18-day moving average. That 1234 area being a stickler. We got above it there on the NOASD report, fell back below. Don't love that. But certainly there is a cluster here between 1230 to 1250. We break through. Beans aren't going to have much in the way of resistance back towards at least $13, I would hope, at 200-day moving average, and soybeans around 1294. So we'll see a positive day here, 4 3/4 cents for the soybeans. We were a lot more positive for corn there at one point, but we'll see what happens. I want to begin today. Let's look at the daily chart of corn. Got some good ideas here, maybe some ways of looking at 22 December corn too. But I don't like a market where we might have an inversion, and that could weigh on that December 22 corn and keep it lagging to the December through this marketing year, right? And we'll have to watch that old crop new crop spread, which we certainly will keep an eye on here, and that will become a discussion into the end of this year and into December. We always start to look at our old crop new crop spreads and see if there isn't some kind of positioning we can't do as that spread is approaching the time frame that I enjoy trading it here into its termination of life at the end of the crop year or at the turn of the crop year. So December corn trading above this and a throwback into the supportive now trend line. It was trend line resistance of the range and the wedge we were in December corn. We broke above that level here back at the end of October. We came back to test it here as support already in November. 18-day moving average here at 554 holding a support. We're above the 200-day, 100-day, and 55-day moving averages. We've got trendline support now that we can count on probably for corn, and we've already broken trendline resistance and tested as support. So this looks like a market that is very much turned ready to go higher, wanting to, in my opinion, probably break out towards $6 at this point. So if we've got December 21 corn going to $6, and we know that corn going out through next year is about at these levels, December 22 corn is at just below 550. and we've got a 23-cent premium for 21 corn to 22 corn. So we're still in inverted market conditions, is my point. That inversion worries me because we could go very well bid in these front month futures and leave that December 22 corn in the dust, not allowing a long in December 22 corn to gain premium or gain profit. But that doesn't mean we can't capitalize on it. But it just means something else we need to be aware of. So let's take a look at the 4-hour chart. Then we'll get into those options here as well. There we go. And now that hasn't happened, so December corn here again breaking above trendline resistance, testing as support. Had a little bit of a multi-day correction. Full 50% retracement from that 506 low for the month of October to the highs here in November. That was around 546. We tested right back down, lows here at 547, traded that 50% area in my opinion. We've got an upside target from, and I will highlight that fib now, activating that drawing. 604 is that negative 23% upside target with a continuation up towards the 635 area, which very interestingly enough is an open gap that I have on the December corn chart that we've left open for quite some time that I would love to see fill way up there on the chart. So all that being said, intraday here, and we have now, we traded an outside day key reversal kind of setup alongside the soybeans there on that final, on Tuesday's news whipsaw. We traded and continued higher yesterday to confirm that reversal setup, and now the first day of higher highs and higher lows. Today ended the second day of higher highs and higher lows. I kind of view this close in corn today as maybe a bit of a bear trap. Nothing about the close was very bearish with the exception of closing back inside of yesterday's range. We still finished barely positive, but positive on the day for December corn. And I think if we immediately start off the evening going higher, I wouldn't be surprised to see a little move below 1266 just to run the stops real quick. But generally speaking, a 50% long from 547 to the 579 highs here, which comes in at 563, which would be a quick move below that low. That would be a 50% ambush long. An ambush long occurs when you have a swing. Take the swing down off this high. We trade through a 61.8 line. So we traded all the way back up through the 50 and 61.8 line of any kind of short off that high. The market now, if you draw up the ambush of the 50, the opposite from the next swing, if the market pulls back into that area, it's a technical setup and a reason, and a reversal setup and a reason to buy the market, in my opinion. So we'll see if that happens. It doesn't need to go there. Certainly today's close could just keep us going higher in this market, going without looking back. If that's going to be the case, and we get through today's high of 579, 586 prior highs for the month of November, right above us, 590 and $6 just above that. And again, we've already pointed out how we've got technical upside targets that could be filled if corn heads higher. So, okay, Dan, what are we looking at in terms of options? What are we thinking might be an opportunity at this time? I actually think December 22 calls. I was talking about these with the client earlier today. They're 550, so let's look at December 22. They've got a lot of time left on them, right? We're talking 379 days, over a year left on them. So it's not like paying premium for them doesn't have value there. It's just the value translates at the time. The 550, the at the money call, I guess it's slightly out of the money by 4 cents. Going for, let's just call it 50 cents here as settlement. That means break even on is $6. Everything above $6 in the December 22 corn would be pure profit, and you've got 379 days to get there and stay above. If we think corn's going to $8 and you want to set it and forget it trade that you can never go on margin call with, well, at least until after its expiration, when not worry about managing a futures position, that might be a good opportunity for $2,500 to own the 550 call that far out. Now, again, my only concern with that strategy is if we remain in inverted market conditions, new crop corn for next year might end up becoming left in the dust if we see that weather premium and other things build into the reason why we go bid in December 21. Then March, May, July corn next year, etc. But that's something we can easily amend by trading the spread itself, and something we will certainly be talking more about in this community, because that's something to consider, certainly. And I've got the little chart up here. We don't need to look at it on the big chart, but the little chart here is the chart of the December to December spread right now at 23 cents over. It was as high as 112 over. I could see this market, bouncing back up here, and it's got a lot of room here to get back to kind of its next resistance, in my opinion, above the 30 over area. Now, we hold resistance here, and in my opinion, we would, which again is broken support. Now, as resistance, we could continue to trend lower. Full carry on these spreads is much lower, so there's no reason we can't head down. But staying inverted, you can go infinitely inverted too, in markets where we need it now and we're not worried about supply after a new harvest, which is the exact situation you could run into by owning December 22 corn calls. But again, that's the risk you have with time, and the penny you pay for it as well. In the near term, though, I think you could potentially own December corn pretty much right here, right around, let's just call it a 570 area. In December corn, the 565 puts, and we're going out a week on these, but we'll look at how they look in a few places. 565 puts here going for 6 cents, call it. You could be long the board here with a total of about 11 cents of risk, and through next week, through the end of next week. So if we continue with corn and we find our way higher, and we find ourselves certainly above 565 in the corn, you wouldn't get called away on that, and put a short and remove from your long. But again, for a total of 11 cents risk, in my opinion, it beats the pants off of buying the market here and putting a stop at 560 against the 570 long, because we could go down to 560 as we saw on the chart. We could still certainly be bullish on a pullback like that. So you still want to give yourself the ability, for the market to come back. But that's a wrap for corn, I think. But pretty clear breakout, I think, beginning here. I like the way the corn chart looks. Today's pullback, I really feel like might be a bit of a bear trap, especially when you consider how bullish wheat looks, and now some of the strength we're seeing on soybeans. So our January soybean chart, we're trading back. Today's close, I would like to have seen it above the highs from yesterday, which you can see there we're at 12.22 half. Today's settlement here at 12.21 half. Okay, not bad, but it was a close in yesterday's range. It is higher highs and higher lows, though, for the second day, but it is still inside price action of our prior massive WASI day. However, the last 2 days, almost all the price action has been inside the wick of that candle. This doesn't look bearish to me just yet. We start to break below today's low and yesterday's low. Call it a 12.09 stop on whatever long you got in the market at this point. I think that should be safe, and we could head higher. Now, I wouldn't be surprised to see a little whipsaw before it all happens, because, hey, beans like to burn you before you get to earn it. But trendline resistance here, if we start to break above 12.35, certainly above the 12.40 highs from yesterday, there's not much in the way, in my opinion, until we get back to a $13, confluence of 100-day and 200-day moving average, as well as our prior kind of congestion lows. And that's something we'll continue to keep an eye on here going forward. The 4-hour chart for January soybeans. Certainly congestion zone resistance here, the 1260, 1280 area, again, where that trend line resistance might be coming down. The last 2 days of price action have been pretty constructive. And actually, I'm going to bring this down to a 15-minute chart. Actually, let's look at a tick chart, 233 tick. So you can really see the price action that's occurred without time being an issue. So this is the big WASD report, big move higher. We then pulled back from the 1181 low. Look at this, 1181 low to the 1240 high. We pulled back into the full 50% retracement and 1211. The market then bounced off that level after a second test here, but we continued to hold it. After both of those tests, every bounce we've had up against towards highs. So we know we're holding a 50% long at this point, or the market is holding this 50% supportive area here. Every bounce we've had in the soybeans off the highs, including this first one, has gone up and punctured the 628 line. 628 line defended by the longs down here. Go back up, puncture the 628 line. So the idea here is that if you've got a line and you've got an offense and a defense, or there's two sides, bulls and bears going at each other, the bulls are causing more damage to the bears chart, right? The bears chart has a short here, bulls chart has a long here, and we're fighting between them. The bulls have punctured, in my opinion, the invalidation zone for the bears twice now. So we start to go higher above 1230. That's going to probably accelerate through the 1240 high. And as we've seen in the chart here, the daily chart, we know that there's not much else going on there. Now, as we break down the last low, the swing low that we just made, okay, the last swing low, and that's actually the lowest low here for soybeans we made here down into 1205. It was the lows of today's of yesterday's kind of midday session, but it was the lowest low since the YC report. That low through the most recent high as a fib pull.
We'll see. I mean,
1216.75 is the 50% retracement. Well, we already pulled back to 1218, so maybe what 1217 is it? So maybe we trade within a penny of that supportive level, what we would refer to as an ambush level. But I wouldn't be surprised to see one more push down towards 1216 to 1214. I'd be a buyer in the beans at that point. You can see on this this chart, we would also call that a trend line, and that's definitely a fib with that trend line support there. We'd be looking for upside of 1233 just off of that trade, probably within the intraday time frame. But then we know that we're also within that larger setup from 1211 that has a 1254 upside target, continuation towards 1277. So we do continue higher in the beans. We can see the constructive price action here when we break down what we refer to as a tick chart. This is taking time out of the equation. You can see the very quick whipsaw price action more clearly. You can see how we're actually trading constructively bullish price levels. Those bullish price levels have defended the invalidation zone so far. We've pushed into the invalidation zones for the bearish side, and now we're just waiting for that short squeeze through the levels. So there's plenty of reason here to technically get long January soybeans from a trading technicals perspective in the futures if you were that type of nitty-gritty surgeon trying to get in and active in the market. However, I do think that there are some other opportunities. A 1240 call, for example, that gets you back to the highs of the week here, and certainly at its cost in the January contract which has 40 days left till Christmas Eve on it. At a cost of 18 cents, it means that getting back to highs of the month at 1261 means you're profitable on this trade against your cost average. And that's also, by the way, the breakout area. So then everything above that is just pure profit. So if we think we're going to $13 by Christmas Eve, you've got the potential of 40 cents there, a pure profit on an 18-cent risk. I think that's certainly within the wheelhouse of potential. And it beats, in my opinion, the pants off of maybe buying futures here with an 18-cent risk, which only put your stop down around $12. And that's still all within the whipsaw range, and nothing really, to be fair, nothing within this range is really safe at this point. We could see the market run stops on either side, and to be fair, I would not say that stops down below the lows of today at 1212 are safe at this point. Soybeans is notorious for going down, running the book, taking out levels that you feel like should be defended, maybe where you personally had a stop. I know it's happened to me in the past. Get ticked out, and then the market heads higher in your favor or lower, whatever the story may be. But that's where you could use put protection, perhaps, to protect yourself. On the options side, going a week out here to next week. So these are November week twos. In the January soybeans, they still go off the January contract. 11/19 is their expiration date, so a week from tomorrow. The 12/10 puts going for 8 cents here. Let me bring those up. The 12/10 puts going for 8 cents makes sense to me. if you're buying beans around here around this 12.20 area, you've got 10 cents of protection from the put strike. Let's call it 12 because it is 12.22 where we settled. So you get 12 cents of protection to your put strike, or that's your risk to the put strike, plus the 8-cent cost, right, of getting into this weekly option. Through next Friday, you could have the same 20-cent cost on a trade, or 20-cent total risk on a trade to be long the futures now in January beans against against a 12.10 strike that goes off the board next Friday. Again, that's an 8-cent cost to buy that 12.10 put, assuming you're out long the futures right here at 12.22. You've got a total of 20 cents of risk out of pocket through next Friday. We go higher. You're profitable on your beans if we go through highs of today at 12.28. We hit 12.30. Every penny above that is pure penny profit at a 1-to-1 delta because, again, you're long the futures here with that put protection. After next Friday, you have to be reconsidering risk in terms of either getting another put or putting a stop in the market. But if we think we're going to break out right here and now, if we want to have a set it and forget it trade through Christmas Eve through January, 18 cents, you can get that 1240 call in the January soybeans. That's a full dated January option. I guess it was going for 19. It settled at 19 and an eighth, but nevertheless, 20-cent cost is what I was kind of putting it at, and that's the important thing to remember. Okay. Now, in the near term, as I mentioned, don't be surprised to see a little bit of support, maybe down into the 12.15 to 12.20 area. That's why I mentioned, hey, if you want to go long futures, I like that 12.15 to 12.20 area in terms of being a buyer there, but I wouldn't do so without that 12.10 put protection in those week 3 Novembers. Again, they go off January, they cost 8 cents, and they keep your all-in risk at around 20 cents on being long the futures through next Friday. Did not mean to completely change and move around my board here. All right, I'll lock it so I can't do that again. All right, let's take a look now at wheat. Wheat really starting to get to those prices where you're like, every new high starts to surprise you a little bit, right? That's what happens when you're at multi-year highs, right? 812.5 settlement there on the Chicago contract. I mean, just a beautifully trending chart above every moving average you can imagine. Closed above the prior high there, which was that 807 high. As bullish as it gets, with the exception of being almost 10 cents off the highs for the day, or just over 10 cents off the highs of the day. We still finished more than that off the lows. So I wouldn't be surprised to see wheat hold its footing right away in the overnight and not really give us a pullback, because it more or less did there into the settlement. You had to have the cojones to hold it through that close, and of course the full margin to do so. And that would be the price and the risk you'd pay, having to have that capital there to do so. I actually don't think that we're not without some opportunity here, particularly if you want to be aggressive with paying very little time value and looking at weekly options. Week 3, 830 calls are going for 6 cents. We'll look at those in a second. We get above the highs of today. Those are in the money, and we get 6 cents above that, and now you're completely profitable against all your costs on the trade. But as you can see on the chart here, we got a trend line, sloping trend line, turning a bit parabolic here for wheat. It's the reason I kind of only would want to come about getting long wheat here via maybe a weekly option, paying very little, less than 10 cents, because we are so parabolic on the chart. If we continue higher, the weekly option that is just above today's high, or at today's high, would go in the money. That would be more than able to get into the money and be very profitable if we continue with this parabolic move. If we reverse higher off these highs, you're going to feel very happy being only wrong with that 6 cents out of pocket in terms of your risk and trying to be long wheat. However, I think it's silly not to try to be long wheat at these levels, because with spring wheat already solidly above 10 and being very comfortable there, KC wheat having cleared $8 well before Chicago and heading higher still, and wheat generally leading the way. If we see the US dollar start to tumble, like I said earlier, how it's so strange to see wheat prices heading in the complete opposite direction of the dollar in the last couple of days, and why we feel that is the canary in the coal mine for the inflation trade being very real. The Treasury selling off as the market putting pressure on the Fed, trying to get them to act on the inflationary pressures rising. And the only thing the Fed can really do in that event is turn off the printing presses and, of course, raise interest rates, which would be dollar positive, which would be negative on the interest on the 10-year and the 30-year on the actual price of the futures, and you would see you'd ultimately see the price of wheat potentially continue higher, because in that event you'd see the price of wheat potentially fall, because it's doesn't need to be as rationed out of the export market if our currency is doing that for it, right? Wheat can get rationed off of the export market via our currency becoming too expensive for exporters to really use. They can swap to a different currency and have better purchasing power in another part of the country, where then the effective purchasing cost of wheat is lower, or by moving the price of wheat in US dollars higher, which is what we've seen over the last several months, because we've obviously got tight stockpiles and no reason for US wheat to be flooding the global market. All right. But it doesn't go without saying that if you look out on the curve in wheat prices going out next year, and certainly out through July of next year, we're well above we're above $8 there. For those wheat producers that like the idea of having some kind of floor in place here, I would not do it without having the upside open, and using cheap weekly calls that you manage week to week, spending just a few pennies to get that upside. If we get these rapid burst inflationary moves that can be absolutely hair on fire rallies, I guess, panic rallies, the FOMO rally. These weekly calls that we can spend very little on can capture that type of move, but it behooves us not to have some kind of protection. So buying puts here makes sense too, but I would try to finance them by potentially selling calls. Obviously, as strong as this market's been, call premium is starting to build out at some high levels, where being called away at $9 or $10 in Chicago wheat is probably a good idea in some regard, where we can, of course, manage reownership and upside, again, with those cheap weekly calls. So with that being said, let's take a look at some of those longer dated options, see if there's any potential there going further out. Let's take a look at, September next year. September wheat, 288 days out, trading at $8.12, people. $8.12. $10 calls. 25 cents we can bring in. And with that 25 cents out of the pocket, you could put a floor in at a break even, or at a zero cost spread here, with a $7 put. So you're $7.10 put. So we can put a floor in wheat for September of 22 at $7. At $7.10. Buying that $7.10 put, it's $1 right below, but and potentially have a $10 call away there by being short the $10 calls at an even money spread. That starts to become very interesting for a part of a marketing plan. And again, we can protect ourselves against the move towards $10 with pretty cheap out of the money call spread or calls, and maybe even in this environment call spreads. Well, if for nothing out of the pocket we can get protection at $7.10 by selling the $10 calls, I would say that maybe above $9 we would start to get antsy to maybe try to have that reownership, to make sure between 9 and 10 we start to make it back, so we're not that call isn't going against us too much. Well, 45 cents, that September call at 45 cents. Kind of doesn't help you much, I guess, in terms of the 22. There'd be effectively a 24-cent cost or 25-cent cost between the 9 and the 10. So you've got at a 20-cent cost for the $9, $10 call spread is what I'm getting at. Is we're trying to weigh the risk-reward ratio here. What's the cost of buying that $9, $10 call spread? That if the market moves $1 higher, and again, this is out of the money by $1. It's got 288 days. We still have have a 20-cent out-of-pocket cost, which just seems a little elaborate to me. So instead of spending 20 cents over the next 288 days, to have that only $1 protection that doesn't do too much for us until we start getting closer to $9 anyway. It makes more sense to me to plan out something that over the next 6 months, over that same time frame, monthly or weekly, you look at spending 5 to 8 cents on a shorter dated option to protect you for that upside, particularly in a market where we're going to see inverted price action, right? We're going to probably see the shorter dated months go bid relative to that September wheat of next year. So putting on a protective strategy by buying a 710 put, selling a $10 call, that risk reversal strategy for a zero credit spread, you could, or an even money spread, you can afford to then out of pocket come in and now take some risk, 20 to 30 cents over the next couple months by buying short dated calls, or shorter dated calls, I should say, because they aren't the short dated ones. We'd be looking at weeklies or maybe the monthlies to help protect against the upside then against that $10 call going against this. And we don't necessarily want to have a $10 call on a futures account, $15 wheat on the board, and be having to meet the margin requirement on that. Obviously, we have the cash to sell. We'll be laughing all the way to the bank still, but it's still there's still futures risk there involved. So, all right, well, with all that being said, that pretty much wraps up where I had our row crops today and some of the ideas. I think being aggressive with calls at the 5:30 or 8:30 strike there in the wheat is how I tackle this parabolic move. Soybeans, I think that there's opportunity here for less than 20 cents of risk out of the pocket, being long either in the futures with some put protection, or just the outright 1240 January calls seem like it seemed like value to me if we're going to see that move to $13, by Christmas. And then corn, with the anticipation of maybe some bear spreading going on in the near term. I think moving into December 22 timeframe in terms of some of the reownership isn't a bad idea. Maybe putting 25% of whatever we're looking for reownership, or doing, kind of more aggressively now, we start to look at that. Again, the 550, those at the money calls going for 50 cents. If you want to do nothing but set it and forget it between now and then, the idea there is that it has a $6 break even. If we're confident corn's going to be above $6 over the next 370 some days, we're going to, for $2,500 out of pocket, you can have basically have the option of being long corn at $6, break even. And that's something that is within the realm of possibility happening. Now, again, we looked at that spread. If it turns the other way and we see bull spreading and that inversion occur, which is very, very common in these types of tight carryout markets, it might make more sense to be long those old crop contracts and do so with those shorter dated put options. We looked at using that 565 put against owning futures here, which would have been around 570. We called it a 5 cent strike risk plus the what did we say those were? Going for 8 cents. It was for 12 to 13 cents of total risk in being long corn here from where we are, and that's something that's kind of made sense to me if we're looking to be more long, long December corn or something, more in the near term. So, thank you for joining us today. Of course, be sure to sign up in the links below to receive our free Zaner Daily newsletter. Feel free to get in touch with me. Can always be reached over here at Zaner at 312-277-0110. Love having conversations about the market, keeping you guys up to date, and of course, talking with you about how we can turn some of these ideas I talked about today, or maybe some that you have, into actionable trading strategies in account for you. So, I can always be reached here, 312-277-0110. That's 312-277-0110. Find me on Twitter, Facebook. Shoot me an email, dhussey@zaner.com. Thanks for joining me, everybody. Sign up if you haven't already to get on that mailing list for the Strategy of the Week webinar every week here at 2 p.m. Central on Thursdays. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.